why never paying off your mortgage could be the only way you become wealthy. By paying off your mortgage, you might be sabotaging your future. If you own a property but find yourself unable to save money to buy real estate investment, then this video is for you. Hey, so today I want to talk to you about something that's been a game changer for me and the planning of my future. It's refinancing my home to buy rental properties. This is exactly how I was able to grow my real estate portfolio in such a short period of time. And if you follow this strategy, you'll see that getting your first down payment is all you need to set yourself up for wealth through real estate. Let's start with a quick review of what is refinancing. Refinancing your mortgage basically means that you are trading your old mortgage for a new one and possibly a new balance. When you refinance your mortgage, your bank or lenders pays off your old mortgage with a new one, possibly leaving you with a payout based on the difference between the debt you owe to the bank and the new value of your home. The best part is, since the money you get out is your equity, there is no tax on it. You don't pay tax on debt. Let's establish that. This is why rich people multiply their wealth by borrowing against their asset to pay for new investment. Typically, mortgage rates, even if they're high, are lower than most loans out there. Also, you can write off the interest because you are using it as a down payment to invest on your next property. And that is because anytime you use borrowed money to invest, you're allowed to write off the interest. You see, refinancing your home can give you access to cash that you can use to invest in rental properties. And I'll show you why that's such a smart move. So you bought your first house and it's super exciting. Everything is going well, but after a while you realize that even though you made the right move by buying a property and building equity, you're not able to save extra money, and that your house is actually the only asset you could acquire. I know the feeling. You can't seem to save for retirement or just have some money aside for rainy days. And when you have this financial pressure, you don't see a way out. Thankfully, if you're a homeowner, you're already on the right path. And since for most of us, our house is the biggest asset we'll ever own, why not try to buy another one, which can give us a steady source of passive income? Another advantage of investing in rental properties is that they can appreciate in value over time. That means that not only you are earning rental income, but you're also building equity in the property. And if you ever decide to sell the property, you could potentially make a significant profit. Plus, real estate is a fairly stable and predictable investment compared to other types of investment like stocks. And by using the equity in your home to invest in rental property, you're leveraging your investment and potentially maximizing your returns. Okay, so when are the best time to refinance? Generally, if you can reduce your current interest rate by 1% or more, it usually makes sense to refinance. It could be because the rates are more favorable at the time, or because your credit score improved since the beginning of your mortgage. Another good time is if you need to consolidate bad debt. Since we saw earlier that your mortgage will have the best interest rate across the board, it's often a good option to get rid of your bad debt by refinancing. Finally, is when you plan to buy an income property, since it allows you to access your equity for a down payment. And of course, the decision should also fit your financial situation. Now, you can refinance pretty much anytime you wish for a fee. However, the most common time to refinance is this way, you'll avoid paying fees for breaking your mortgage early. So how does the refinance process actually work? Once you've sent all the necessary documents to your broker or lender and you've been approved, the first hurdle is the appraisal. Usually, the bank will send an appraiser to your house to estimate its value. They will then typically lend you 80% of the current value minus what you already owe them, obviously. For example, if you bought your house for $400,000 and put a $40,000 down payment, you have a mortgage of $360,000. After 4 years, say you've paid $35,000 in principal, so the amount still owing is $325,000. Now, 4 years later, your house is worth, let's say, $480,000. That is a 5% a year in appreciation, which is very typical in real estate. So 80% of that amount is $384,000. you'll have to subtract the $325 you owed the bank. This leaves you with $59,000. That's the money that you can extract right now out of your house. Let's not forget that you still have the other 20% equity in your house, in this case, $96,000. Yes, I know what you're going to tell me. Are you crazy, Julian? Now I've increased my debts and I owe more money to the bank than when I bought my house 4 years ago. That is right. You owe $384,000. Your outstanding mortgage balance, $325,000 plus the $59,000 you just borrowed. It is more than the $360,000 you started 4 years ago. And yes, your mortgage payment is now higher every month. But you also have $59,000 sitting in your bank account at the cheapest rate you could get. That's why we never refinance our home to buy a new car or other liabilities. We have to buy assets with our equity, and precisely a positive cash flow rental property. The positive cash flow from your rental property should cover the difference of the new higher monthly mortgage payments on your home. With this strategy, you only have to find your first down payment. Then once you build enough equity, you can refinance your house to get some money out and buy your first rental property. Not only are your tenants paying down your mortgage, you're also building equity in this property, which will eventually lead you to be able to purchase another property, and so on. Now, I'm sure you see that if you play the game properly, you could be on your way to be financially independent in a short few years. It's important to know about good debts and how to use it to your advantage. Of course, there are challenges involved with investing in rental properties, such as finding good tenants or dealing with maintenance and repairs. But if you do your research, invest wisely, and manage your properties well, it can be an incredibly rewarding and lucrative investment strategy. For me, it most definitely is. So, there you have it, the advantages of refinancing your home to buy a rental property. If you're interested in exploring this strategy further, be sure to consult with a mortgage specialist who can help you make an informed decision. And as always, thanks for watching, and we'll see you soon.